Cyclicals are once again the talk of the town in 2023. The following are the hyper-growth stocks to buy as growth names continue to run hot while interest rates peak. Twilio. Twilio stock is yet to see a rally despite its track record of beating analyst expectations. Intuit, as the economy cools off, the company is well positioned to increase profits as it has industry-leading margins. Enphase Energy. The growth story for renewable energy is just starting. Solar is one of the best ways to profit from that. Let's dive in. Here are the 3 thrilling hyper-growth stocks for aggressive investors to buy. Welcome to Timely Investment Research. Many analysts have reached a consensus right now that the market has likely bottomed in the near term. The strength in the economy is robust, and the recent bank bailouts by the Federal Reserve have started to loosen monetary policy despite the rate hikes. Following a tumultuous 2022, tech stocks have made a striking comeback in 2023, drawing attention from investors seeking hyper-growth stocks to buy. The recovering confidence in the banking sector has diverted investor focus toward more cyclical names, creating a favorable environment for growth stocks. Analysts also anticipate the Federal Reserve may reconsider its rate hikes, leading to a potential resurgence in growth stocks. Of course, there are fears that the growth rally is overdone and the economy is due for a recession following the rate hikes. But with the Fed's balance sheet undoing around 4 months of quantitative tightening, I believe the possibility of a recession is insignificant in the near term. The only worry is that inflation may start rising again if there is too much liquidity in the economy, which can cause some panic in the future. With that in mind, investors should look into these 3 hyper-growth stocks to buy. Number 1. Twilio. While most other growth stocks have exploded in recent months, Twilio has remained overlooked. However, the stock is slowly making a comeback, up 16.7% year-to-date, but remains 86.5% below its February 2021 peak. I believe Twilio stock is poised for a resurgence this year as it is already building some momentum. The cloud communications platform enables developers to integrate various communication services into applications and has seen remarkable expansion since its 2016 IPO. While the inflation and interest rate increases pose some challenges, the outlook seems very optimistic as we advance. What's more is that the company has been consistently beating analyst estimates. Twilio reported fourth quarter revenue of $1.02 billion, up 22% year over year, and substantially narrowed its losses from $482 million in third quarter to $229 million in fourth quarter. That's mainly due to the cost-cutting initiatives the company went through, such as reducing its workforce by 17%. Admittedly, the top-line growth is indeed slowing down. But investors also need to consider that Twilio's growth will likely pick back up as the economy recovers. Many cyclical tech names use the company's services, and the temporary slowdown shouldn't warrant a low valuation. Number 2. Intuit. Intuit is another business the market has underappreciated so far. It specializes in financial software such as TurboTax, QuickBooks, and MailChimp. Sure, Intuit stock still trades at a premium with a price-to-earnings ratio of 63.8x. However, its forward PE ratio is at 28.6x, meaning that analysts expect much higher earnings in the future. But what makes me really bullish about the stock is its remarkable margins. Its gross margin is at a remarkable 79%, while its net margin is at 14.2%, both ranked better than approximately 85% of other software companies. Furthermore, the 3-year book growth rate per share is nearly 60%. That's better than approximately 90% of its peers, showing that the company is rapidly building its asset base. Much like other companies, top-line growth has slowed down here too. But as the macroeconomic situation eases, I expect that to turn a corner. The stock has considerable upside potential. We expect a 33% upside potential from the current price with a $580 target. Number 3. Enphase Energy. Enphase Energy is too good to ignore now. While fossil fuel-reliant companies have likely peaked even with the recent OPEC production cut, Enphase Energy seems well-positioned to deliver outsized gains. Countries worldwide are accelerating their efforts to increase their renewable energy output, and solar remains one of the best ways to do so. First, Enphase Energy's financials are shining green. Its 3-year revenue growth rate is 50.4%, outperforming almost 95% of its peers. Even better, Enphase Energy's 3-year earnings before interest, taxes, depreciation, and amortization growth is at 61%. I expect the growth to accelerate more as the solar trend picks up. But even with the current growth rate, its forward PE ratio of 69.44x calls for more upside. Indeed, analysts think the same. The average Wall Street target is $293, with a 54.8% upside. Some analysts think it can go even higher, with Sophie Karp from KeyBank expecting a 91.5% upside potential. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.